Good day, ABM Business Finance learners. In this video, we will discuss the lesson 6 that focus on working capital management. Let us define what working capital is. Working capital is the difference between a company's current assets and its current liabilities. It is a measure of a company's operational efficiency and short-term financial health. In accounting, working capital refers to the excess of current assets over current liabilities. In finance, it is referred to as net working capital. It is expressed as working capital is equal to current assets minus current liabilities. Negative working capital. The ratio of current assets to liabilities is less than 1. Example, 0.70 is to 1. Positive working capital. The ratio of current assets to liabilities is greater than 1. Example, 3 is to 1. It indicates that a company can fund its current operations and invest in the future activities and growth. High working capital is not always a good thing. It might indicate that the business has too much inventory or not investing its excess cash. A business will typically need working capital when its operating cycle is too long. The business will make an initial outlay of cash to produce goods or inventory. Sell the goods and inventory through cash or credit, and receive cash from customers after the credit policy and related payment terms is applied. What is operating cycle? The operating cycle is the time required for a company's cash to be put into its operation and then returned to the company's cash account. The operating cycle is the sum of the days of inventory, which can be computed by 365 or 360 days divided by inventory turnover, and the days of receivables, which can be computed by 365 or 360 days divided by accounts receivable turnover. Now let us know what days of inventory is and its formula. Days of inventory or inventory conversion period or average age of inventories is the average number of days to sell its inventory. The formula is days of inventory is equal to 365 or 360 days divided by inventory turnover. The inventory turnover is cost of goods sold divided by the sum of beginning and ending inventory divided by 2. Or it could be days of inventory is equal to inventory divided by average cost of goods sold per day. Let us take this example. Fabulous income statement shows her beginning inventory for 2019 was 10,000 pesos and her ending inventory balance was 7,300 pesos. The cost of goods sold for the year was 50,000 pesos. The given for this problem are beginning inventory 10,000 pesos, ending inventory 7,300, and the cost of goods sold is 50,000 pesos. Now let us solve. Let us compute this first using this formula, where we need to compute the inventory turnover first. Let us compute for the inventory turnover. Cost of goods sold divided by the sum of beginning and ending inventory divided by 2, and that will be 50,000 divided by 10,000 plus 7,300 divided by 2, and that will be 5.78. And that 5.78 will be used for computing our DSI. In computing for DSI, 365 days is used. 365 divided by 5.78 as our inventory turnover is equal to 63.15 days. This means it takes Fabulous approximately 63 days to turn her inventory to sales. Now let us compute using the other formula where we don't need to compute the inventory turnover. Days of inventory is equal to inventory divided by average cost of goods sold per day. And that will be days of inventory is equal to 7,300 divided by 50,000 over 365 since we need to compute how much is the cost of goods sold per day. So that will be 7,300 over 136.99 is equal to 53.29. In this formula, it takes Fabulous approximately 53 days to turn her inventory to sales. The last formula that we use is used when beginning and ending inventory is not available for computation. Now let us know what days of sales outstanding is. And its formula. Days of sales outstanding or DSO or days of receivables is the average time for the company to collect its receivable. And the formula is days of sales outstanding is equal to 365 or 360 days divided by receivable turnover. In computing for receivable turnover, that will be receivable turnover is equal to net credit sales divided by the sum of beginning accounts receivable and ending accounts receivable divided by 2. Or days of sales outstanding is equal to receivables divided by sales over 360 or 365 days. That is without computing the receivable turnover. Now let us take this example. Fabulous accounts receivable beginning balance was 10,000 pesos with an ending accounts receivable balance of 7,000 pesos. Total credit sales for the year is 100,000 pesos. The given are accounts receivable beginning 10,000 pesos, accounts receivable ending 7,000 pesos, and its credit sales amounting to 100,000 pesos. Now let us compute this using the formula where we need to compute first the receivable turnover. Receivable turnover is equal to net credit sales divided by the sum of beginning and ending accounts receivable divided by 2. And that will be 100,000 pesos divided by 10,000 plus 7,000 divided by 2 is equal to 11.76. And that is 11.76 is the receivable turnover, where we can now compute the DSO. Days of sales outstanding is equal to 365 or 360 days over receivable turnover. So that is 365. We use the 365 here. Okay, 365 divided by 11.76 and that will be 31.04 days. This means that Fabulous takes an average of 31 days to get paid for sales made on account. Now let us use the other formula where we don't need to compute for the receivable turnover. And that is days of sales outstanding is equal to receivables divided by sales over 360 or 365 days. So let us substitute receivables That is 7,000 pesos. And our sales, the net credit sales is 100,000 pesos divided by 365. Okay, so that will be 7,000 divided by 273.97 is equal to 25.55 or 26 days. Okay, so it takes Fabulous 26 days for their sales to be collected. Now let us know what days of payables outstanding are DPOs and its formula. Days of payables outstanding or DPO is the average number of days for the company to pay its creditors. And the formula is days of payables outstanding is equal to 365 or 360 days divided by payables turnover. Payables turnover can be computed by net credit sales divided by the sum of beginning and ending accounts payables divided by 2. Or days of payables outstanding is equal to payables divided by cost of sales over 360 or 365 days. Let us take this example. Fabulous had a beginning accounts payable of 7,500, ending accounts payable balance of 8,100. The cost of goods sold for the year was 50,000 pesos. Now let us compute this using this formula. Days of payables outstanding is equal to payables divided by cost of sales or cost of goods sold over 360 or 365 days. Now, that will be 8,100 divided by 50,000 over 365 days, and that will become 8,100 divided by 137, and the answer will be 59.12 days. So it means Fabulous needs 59 days to pay their creditors. Or their suppliers. Okay, so we can also use the next formula, which is days of payables outstanding is equal to 365 or 360 days divided by payables turnover. But in computing the payables turnover, we will need the net credit sales divided by the sum of beginning and ending accounts payable divided by 2. But since net credit sales is not mentioned in this given, so we don't need to compute for that. But we can also use this by using the net credit sales given in our previous example. Okay? Now let us proceed to cash conversion cycle. What is cash conversion cycle or the CCC? Cash conversion cycle is also called the net operating cycle and is computed as the operating cycle less days of payable. The cash conversion cycle is the length of time it takes for the initial cash outflows for goods and services purchased. It could be materials, labor, and etc. to be realized as cash inflows from sales, whether cash sales and in the collection of receivables. A business with a lower CCC has a better cash position than a business with a long CCC. The reduction of CCC is another important task of financial manager that must be given high priority. The formula for cash conversion cycle is cash conversion cycle is equal to operating cycle less days of payables, or cash conversion cycle is equal to sum of days of inventory and days of receivables less days of payables. Now, let us compute the CCC of Fabulous. The days of inventory is 63 days, and the days of receivables is 31 days, and the days of payables is 59 days. Now let us add the operating cycle, 63 plus 31 days minus 59 days, and that will be 35 days. What does that mean? So it means that it takes 35 days to turn inventory into cash. The shorter the cash conversion cycle, the better the company is doing in terms of selling inventory and recovering cash while paying suppliers. The lower the CCC, the better. A negative cash conversion is best as it means you maintain limited inventory, get paid quickly, and generally do not pay your creditors until customers pay you. Working capital management. It is the administration and control of the company's working capital. The primary objective is to achieve a balance between profitability and risk. Managing working capital is important because failure to do so may result in the closure of a business. We have two types of working capital, and that is permanent working capital and temporary working capital. Permanent working capital is the minimum level of current assets required by a firm to carry on its business operations given its production capacity or relevant sales range. Temporary working capital is the excess of working capital over the permanent working capital given its production capacity or relevant sales range. Let us read the illustrative sample for us to understand the types of working capital. Seth Bentley is managing the working capital of SB Ice Cream. SB Ice Cream is engaged in selling of different ice cream flavors. The following are the sales volume and the working capital needed based on the recent years. For the first quarter, we earned a sales of 200,000 pesos and the working capital needed is 120,000 pesos. For the second quarter, we earned 900,000 pesos and the working capital for this is 300,000 pesos. For the third quarter, we earned 750,000 pesos and the working capital needed for this is 250,000. For the fourth quarter, we earned 350,000 pesos and the working capital needed is 150,000 pesos. We can see that the working capital never goes below 120,000 pesos. That is the permanent working capital requirement. The maximum temporary working capital is 180,000. And that is the difference between the 300,000 working capital and the permanent working capital of 120,000 pesos. That is at the peak season with 900,000 peso sales level. For the fourth quarter, the temporary working capital is 30,000 pesos. That is the difference between the 150,000 working capital and the permanent working capital of 120,000 pesos. We also have three types of working capital financing policies. What are these? Maturity matching working capital financing policy, aggressive working capital financing policy, and the conservative working capital financing policy. What is maturity matching working capital financing policy? Based on the maturity matching working capital financing policy, permanent working capital requirements should be financed by long-term sources while temporary working capital requirements should be financed by short-term sources of financing. Long-term sources of financing include long-term debt and equity, such as common stock and preferred stock. Short-term sources include short-term loans from a bank. These short-term loans from banks are called working capital loans, which perfectly describe the reasons why these loans are incurred. All permanent working capital must be financed by long-term sources, while temporary working capital requirements should be financed by short-term sources. Now let us discuss the aggressive working capital financing policy. Under aggressive working capital financing policy, some of the permanent working capital requirements are financed by short-term sources of financing. Why do managers of some companies adopt this policy? It is because long-term sources of funds have higher costs as compared to short-term sources of financing. By financing some of the permanent working capital requirements with short-term sources of financing, financing cost is minimized, which in turn improves net income. What is the trade-off? Since it is short-term, the debt has to be paid soon, and the company may not yet have enough cash by the time the debt matures. This refers to liquidity risk, and this risk increases with the aggressive working capital financing policy. Now let us proceed to conservative working capital financing policy. Based on the conservative working capital financing policy, even some of the temporary working capital requirements are financed by long-term sources of financing. This policy minimizes liquidity risk, but it also reduces the company's profitability because long-term sources of financing entail higher costs. Now let us proceed to tools in managing working capital. Let's present first the cash management. For cash management, we have to do a cash planning and budgeting. We will do the forecasting of all future cash flows with value and timing. We also need to present the optimum cash balance. Let us keep bare minimum cash balance to meet immediate needs. We should also arrange cash in periods of deficiency. During the period of low cash inflows and higher cash outflows, the firm must arrange to obtain cash to meet the requirements. Investing cash surplus. If we have cash surplus, the idle cash does not provide earnings, so surplus cash is invested to obtain some income. And we should manage cash flows. Firms should try its best to accelerate cash inflows and decelerate cash inflows. Now, what are the tools in receivable management? So first, we should set credit policies. Number two, we should do credit evaluation or the 5 C's. What are these 5 C's? Character. The character or the willingness of the borrower to pay the loan. Number two, capacity. Does the borrower or the customer has the ability to generate cash flows? And number three, collateral. Does the customer has a collateral or the security pledge for payment of the loan? Number four, capital. Does a customer has a financial resources? Number five, condition. The current economic or business conditions. Is it good for her business or to your business? Next, have a good billing collection system. Of course. Number four, determine and monitor the aging receivables. Now, what are the tools in inventory management? We have here ABC analysis, determining economic order quantity or EOQ, reorder point and safety stock. We also have just-in-time management method and materials requirement planning or MRP inventory management method. Let us discuss first the ABC analysis. In ABC analysis, one way to control inventory is to classify inventory into a classification system called ABC analysis. How to do this? So inventories classified as A are high-valued items which should be safeguarded the most. B items, on the other hand, are average cost items that should be safeguarded more than C items but not as much as A items. C items have low cost and is the least safeguarded. Next, determining economic order quantity or EOQ, reorder point and safety stock. How to do this? When ordering materials for production, it is necessary to order in batches at periodic intervals. The quantity of any material to be ordered at a time is to decide in order to optimize the ordering cost and inventory carrying cost or the inventory holding cost. Appropriate amount of safety stock depends on the number of factors. If uncertainty regarding the consumption of inventory is higher, greater safety stock must be carried. Similarly, greater the risk of lead time variation, the larger safety stocks must be carried. Once the total annual consumption of the order batch quantity have been fixed, the ordering must take place in such a way that the quantity ordered when received will replenish the consumption in the intervening period to the original quantity held. Now, what is just-in-time management method or the GIT method? Just-in-time management or GIT method allows companies to have significant amounts of money and reduce waste by keeping only the inventory they need to produce and sell products. Materials requirement planning or MRP inventory management method is a sales forecast dependent, meaning that manufacturers must have accurate sales records to enable accurate planning of inventory needs and communicate those needs with material suppliers in a timely manner. That's it. Thank you.